Hi there, very good evening. You're watching The Money Show right here on ET Now. I'm Kanishka Sarkar and this is your one-stop destination for all personal finance queries. First of all, wishing all our viewers a very, very happy new year. Well, at the start of 2026, if you've been wondering how to structure your SIPs, whether to keep those small cap funds in your portfolio or how to invest for wealth creation over the next 15 to 20 years, tonight is for you. We have a very special episode lined up with personal finance expert Pankaj Matwal, who will answer a bunch of detailed real-life questions from our viewers covering mutual funds, international diversification, portfolio cleanup and long-term wealth targeting. Pankaj, great to have you today. First of all, wishing you a very happy new year. Thank you so much for joining us today.
Kanishka, thank you very much and wishing you a very happy new year to you and all viewers of ET Now. And thank you very much for having me on the show.
Absolutely. Well, Pankaj, today we have investors across age groups, salaried professionals, young earners, long-term retirement planners, and even senior citizens. So let's dive straight into our very first query today. And we'll begin with Nagesh Burate. He's 42 years old, working in the private sector. He's saving over 2.3 lakh rupees every month and is already sitting on a 3 crore rupees portfolio with strong insurance and a solid emergency fund as well. And his goals are very clearly defined. Retirement in 8 years and his daughter's education and marriage over the next decade. But Pankaj, when you look at his portfolio, what's the first thoughts that you have? What immediately stands out for you?
Kanishka, though he has accumulated a good amount of wealth, but the thing is, his portfolio is very complex. He has kept various strategies in his portfolio. And looking at the time horizon, I think that he should simplify his portfolio. That is very, very important.
Now, like you pointed out, he must simplify it. So his equity exposure is fairly high, especially with retirement not too far away. Should that really worry him?
Exactly, because there are multiple goals and time is limited. And second thing, not only that equity exposure is high, but he has implemented various strategies. He is investing in mutual fund as well as in a small case. Along with that, he also invests in direct equity. So it makes his portfolio a little riskier.
So now you've said that his portfolio is riskier. He's also informed us that he recently switched an SIP from an additional international equity fund to a thematic advantage fund, saying that Parag Parikh already gives him this global exposure that he was looking for. So do you think that's a small call or does he need to simplify?
Again, this may not be a right strategy. The reason is that the Parag Parikh flexi cap funds has around 12% allocation in international equity. But as far as ICICI Prudential US Blue Chip Fund is concerned, that is a pure equity fund. Now, so his international exposure has reduced in the portfolio. The fund which he has selected is a thematic advantage fund, which is a thematic fund. Fund is good, but the concern is his exposure to international equity, which was earlier significantly reasonably good, now is being reduced. So he should have not done actually ideally.
Understood. And finally, I just wanted to understand, does it make sense for him to replace multiple small cases with a single multi-factor fund? How would you guide him, finally on structuring his portfolio with the goal that he has in mind?
No, Kanishka, I'll say that again, he already has implemented multiple strategies. So adding one that a multi-factor fund will not be a good idea. He should rather reduce exposure in direct equity and should add a diversified fund like ICICI Prudential, a large and mid-cap fund.
Understood. So that's the view coming in for Nagesh, and not just Nagesh. I'm sure many of our other viewers also have similar queries, and this will definitely help them to, structure their portfolio. And of course, diversification is the key, but to a certain extent, that's the latest word coming in. But let's move on. Our second question is coming from Suryaveer Singh. He's investing for the next 20 years across large cap, mid cap, flexi cap, small cap, and also value funds. Now, Pankaj's concern is, does holding two funds from the same AMC, does that really matter? Could that be a cause of concern? Should he look at diversifying into some other fund?
See, ideally, one should invest across different AMCs, but still having two schemes, one is flexi cap and another one is mid cap from Kotak Mutual Fund. I think he should not be much worried about it because there are multiple fund managers and different strategies they implement in different schemes, so he can stay invested in both schemes.
That's the latest for Suryaveer. I hope that really answers his query. But now a very interesting query coming in. A young investor, short-term goal. Now Rajesh, he's from Chennai, 34 years of age, and wants to win the 15 lakh corpus by 2028. That's in the slightly near term is what we can call it, or medium term, or this could be by early 2029 also. Now he also has a policy that's maturing next year. Now that brings to him 3.4 lakh rupees. So is equity the right choice for such a short time frame, and how should he deploy the maturity proceeds? What is your view, Pankaj?
See, as you mentioned, I agree with you that 3 years is not the ideal time horizon for investing equity. Second thing, the target he has set for himself, that also looks difficult to achieve with the current investment planning. The 91,000 rupees lump sum plus 5,000 rupees SIP in 3 years, we can expect around 2 crore 88 lakh. That also, if you calculated 12%, in 3 years, expecting 12% CAGR is also not very realistic. Second thing, the 3.40 lakh, what he's expecting from life insurance policy as a maturity benefit, if that is also reinvested along with this, and again, we assume 10 to 12% return. So it's difficult, means he can expect around 7 lakh rupees in 3 years, not at 15 lakh. For 15 lakh rupees target, then he should increase his SIP to 28,000 to 30,000 per month. And second thing, he should have allocation in hybrid rather than pure equity right now, because the total investment is equity only. So the current investment and also that maturity proceeds of life insurance policy should go in hybrid fund.
So hybrid fund, that's the key looks like here, and that's how you could look at diversifying your portfolio once you have those, life insurance proceeds in, insurance policy proceeds in for that matter. But Pankaj, stay on with us. We'll stop for a very short break and be right back to answer more of our viewer queries on the other side. Hi there, welcome back to ET Now. You're watching The Money Show with me, Kanishka Sarkar, right here on ET Now. And we're answering all your portfolio-specific queries, helping you build your portfolio with our guide today, Pankaj Matwal. And Pankaj is still with us. Pankaj, let's get back to all the queries then. And we now have a very important and an emotional question coming in. This is from Nalin Shah. He's a senior citizen. He's now actually worried about heavy losses that he has seen over the past 10 months. Of course, markets have been very volatile. So, Pankaj, what's the first thing that you would tell to an investor who is, stuck in a situation like this?
See, Kanishka, first thing, specifically we talk about Nalin Shah is a senior citizen. So 10 months ago only he started investment, and that too in direct equity along with his mutual funds. And here, see, first suggestion for anybody, whether you're a senior citizen or you are young, your investment horizon should be longer when you want to invest in equity. Second thing, your choice of schemes should be good, not like that based on the recency bias or based on the recent past performance. You should select mutual funds in your portfolio. Second thing, direct stocks. I'll say that unless you really have very good knowledge about equity market, you should not invest in direct stocks, because professionals help will be the right thing when you enter especially in equity market. So investing through mutual funds makes a better sense. So for everyone, I'll say that start with mutual fund and tech to with not like a thematic small cap, rather stick to diversified funds initially. Once you have very good knowledge, then only think about further diversifying to the small cap or different strategies or thematic or sectoral. So for Nalin Shah right now, because he has made a loss in his portfolio, my suggestion that one, he'll have to stay invested for some more time. Second thing, he should correct his portfolio, Kanishka, that is very important. His portfolio is very aggressive, though I do not have information about the mutual fund schemes, and I'm not authorized to recommend or give suggestion on direct stocks. But what I can see here and what I can see the loss in the portfolio, my suggestion that with the help of some professional, he should make necessary changes in the portfolio so that when market improves, he can recover the loss.
Okay, so he can recover that loss. Pankaj, you've said that he should stay invested for some more time to at least recover his losses. However, right at the start of your investment journey, it's not the best idea to enter directly into equities. You could look at starting with mutual funds probably. But of course, exiting equity entirely won't always be the right answer, right?
No, but direct stocks, because as I said, I'm not authorized to give my suggestion on stocks. But what I can see there, it looks like that he has invested in some stocks which were like in news or some momentum based strategy he has made. So my suggestion that with the help of expert, he should think of exiting stocks and invest in mutual funds, especially in direct mutual in hybrid mutual funds. So of course he will incur the losses, he will book the losses, but when he invests in right schemes, he may recover that loss through the mutual funds in some time, not immediately. It takes some time because loss is quite significant. But at least instead of increasing the loss, it will be better that he choose the right scheme so that it takes lesser time for the improvement of the portfolio.
Selection, choosing the right scheme, that's very important. That's the word coming from Pankaj. But Pankaj, let's talk about another query. This one is coming from a retirement perspective, yet another one, and they have a fairly long time horizon, that is 18 years. So fairly young investor, we could call it probably. So this question is coming from Jay. He's writing to us from Mumbai. He's 40 and he's looking to invest for retirement over the next 18 years. So very, good amount that he's looking at. Right now, he already has about 35 lakhs of equity corpus that's spread across flexi cap, value contra, mid cap, small cap, and also gold funds. So fairly diversified, actually quite diversified portfolio is what he has. So what would you suggest? What kind of retirement corpus can he realistically expect given the kind of investments he's made already? What is it that he should be expecting? Any tweaks that you would like to suggest?
Kanishka, say he has quite good time in his hand. That time horizon is around 18 years and 35 lakh rupees has been accumulated by now, plus 1,50,000 rupees per month SIP. If I simply calculate at 12% CAGR, he can expect around 13 crore in 18 years. But Kanishka, one thing is very important to understand for him as well as for other viewers as well, that money loses its value over a period of time. And in 13 years, if I assume 6% inflation, the value of this 13 crore will be around 5 crore rupees. So keeping that in mind, though 5 crore is also a good amount, no doubt, but he should step up his SIP because in 18 years, I expect that his income will increase year after year. We can expect that. And with this, if 10% step up, he can set up, that will be the good thing. And with 10% step up, he can expect around 23 crores in 18 years. So that is one suggestion. Step up is the key for the growth and to beat inflation in long term. Second thing, one international fund. See, mutual funds are not accepting right now the fresh investment, but yes, he can get exposure through ETF. So Nasdaq 100 ETF he can consider in his portfolio.
Okay, so you could add some international ETFs in your portfolio. A very important word that has come from Pankaj, that 13 crore, that's the value that you could have over 18 years if you continue to invest like this. But very important to know that money does lose its value over time. So by the time that 18-year period passes and keeping all of the inflation in mind that we might see over the years, this could be valued at around 5 crore, not as much as you're looking at. So the suggestion, of course, is that you must step up your SIPs by 10%, and that could actually lead to a portfolio of 23 crores at the end of 18 years. So yes, very good suggestion coming in from Pankaj. Pankaj, lastly, before we let you go, it's the start of 2026. Tell us some of the key investment decisions one should make. Any suggestions that you would like to make for somebody who's just starting out their investment journey? How should they structure their portfolio? Some things to keep in mind. And, basically somebody just starting on their investment journey in 2026, what would your word of advice be to them?
Kanisha, first thing, everybody should set their goals, their financial goals, whether these are short-term, medium-term, or long-term, but goals should be set. And based on your goals, you should allocate your money in different asset classes. Say markets will keep fluctuating, but your goals will remain fixed. So once you know what is your goal and how much time is left to achieve that, you can decide which kind of asset classes or what kind of schemes can be in a portfolio. So very important. Second thing is that emotional biases. Most of time we see that investors, they take investment decisions based on many emotional biases, whether it's a herd mentality, that what others are doing, they also do the same thing, which may not be suitable for them. Second thing, based on the recent performance of any asset class or any market segment, they allocate their money largely in that asset class or in that market segment. So that should not be done. Third thing, whenever there is volatility in the market, investors exit the equity market, or they reduce their exposure, or they stop their SIPs. That one should not do. So these are the simple things. Means maintain discipline, stick to your goal, stick to your plan. That will only help you creating wealth and achieving your goal in long term.
All right, so be patient, maintain discipline. That's the way to achieve your goals of wealth creation. And Pankaj, you know what? I was just going through the queries again, and what really stands out today is that no two investors are the same, but the principles, they never change, like you highlighted. Discipline, asset allocation, and patience. Those are the keys. Markets will keep fluctuating, but a well-structured portfolio that really keeps the investors focused on their goals, right?
Exactly. That is very important. See here, like I also got a little emotional when the senior citizen has lost a good amount of money. So why it has happened? Because as I said, that his decision was mostly emotional, what I understand from the query. So that is why if you understand your risk appetite, you know that how much time you have in your hand to achieve that goal, and your allocation is not biased. So definitely then this kind of loss will not expect. And your expectation from mutual funds especially should be very realistic. See, mutual funds help you creating wealth in long term, but we understand there are different kinds of mutual funds. There are equity funds, debt funds, hybrid funds, gold funds. So one should select the right kind of funds. And within equity also, it's not that because equity small cap has delivered very high returns, so it does not mean that you invest your whole money in small cap only. Stick to your plan, maintain discipline. That is very important. One thing which is good for others may not be suitable for you. Scheme may be good, but may not be suitable for you. So that is why first thing, what is good for you, that you should do, and take help of professionals. If you do not have very good knowledge about capital market, especially equity markets.
Right. So we must definitely take professional help if we're not all that through with the markets. So that's the very important word that has come from Pankaj. First of all, have very realistic expectations. It's not going to be a magical journey. So yes, you must have very realistic expectations. Stick to your plan, stick to your goals that you're looking at, and also maintain discipline and take professional help if at all needed. Always a pleasure getting your insights, Pankaj. Thank you so much for joining us today. And once again, many New Year wishes to you. Thank you for joining us today and for your time.
Thank you very much, Kanishka. Once again, Happy New Year to you too.
All right, and to our viewers, keep those questions coming in, and we'll keep helping you turn confusion into clarity right here on The Money Show. But it's time now for a wrap, and one for, the last time. Before I sign off, one last time from ET Now, I want to say a very heartfelt thank you to my incredible co-anchors that have been there, Ankita, Srishti, Ashesha, Kavita, and our ever-dependable PCI team, our directors Akshay sir, Ravinder sir, Santosh sir, Vishal sir, our producers, Aditi, Ruchira, Anjali, Patricia, Ananya, Shaurya, all of you, our sharp and tireless research team, Rabinder, Shivam, Ishika, Harsh, Mitali, Meryl, and our guest team and assignment teams, incredible support that they offer us. And last but truly not the least, Aisha and Sajid for trusting me and giving me this unforgettable opportunity at ET Now. This journey has been nothing short of special. It's not just an experience, but also friendships that I'll carry forward with me for the rest of my life. And most importantly, thank you to our viewers for welcoming me into your homes and trusting me with your time. Well, so until next time and one last time here, it's a wrap and a goodbye from me, Kanishka Sarkar. Here's to new beginnings. But before we wrap this edition of the Money Show, here's a quick roundup of how 2025 was, how all of the asset classes performed in 2025, from equities, mutual funds to precious metals, and what really are experts projecting will drive the momentum in 2026.
As we step into 2026, the big question over here remains: which asset class will lead the race next year? Will equities make a strong comeback? Will fixed income offer the right balance of return and safety? Will gold and silver continue to shine? Or will crypto surprise everyone yet again? Now, to decode this battle, we have an exceptional panel with us today. We are joined by Mr. Sandeep Bagla, CEO, Trust Mutual Fund; Abhishek Hussain, Head of Fixed Income, Kotak Mahindra AMC; Ajit Khurana, Founder, Reflexical; Dharmesh Bhatia, Commodities Expert from Dubai; Chintan Haria, Principal Investment Strategy, ICICI Pru AMC. So 1 hour, one debate and one winner. Hi, good evening. Welcome all of you. And this is the War of Asset Classes 2026 and we begin right now. Happy New Year to all of you. And Sandeep, I'll come to you first. Are we planning, equities planning to beat fixed deposit returns like what we saw in 2025?
Hi, Merry Christmas and Happy New Year. Thank you for having me on the show. So, actually, if you see, in equities 2025, I was seeing the 1 year returns. Large caps are close to 7 to 8%. Small caps are minus 8%. So this has been quite a tale of two cities. And fixed income has been actually quite good, between 7 to 8% returns have been generated across the short duration and liquid funds. See, I think it is reflective of the situation that we are in globally and in India. In India especially, growth has somewhat tapered. While there is growth in real GDP, the nominal GDP is not really growing. And valuations are on the higher side, and valuations are on the higher side from historical standards and in comparison to some of our emerging market peers, because of which emerging markets, the other countries in emerging markets have fared far better compared to Indian stock markets. So I think one should, remain invested in equities. One doesn't have a choice, but the return expectations have to be lower. I think if earning growth does not come back with a flourish, then equity market returns are likely to be tapered this year also.
That's a take coming in from you, Sandeep, and we'll discuss more because I really want to know your house views and your stock specific, your sector specific recommendation. But before I do that, let's go across Dharmesh, because Dharmesh, what a year! Gold and silver still shining, and what's the outlook out here? What are you gauging? And yes, profit booking likely to happen in silver, but then the trend is likely to continue. What are you analyzing?
Happy New Year to everybody. Definitely the euphoria is amazing. This year, silver has given 100% more than gold. Gold is around 20-25% annualized return, whereas silver has given 120. And today also fresh high on the silver pricing. As you know, it's really a volatile commodity, and after breaching the $50 mark, that the way it has gone almost $20 in the span of less than a month. Profit booking can be anticipated, but again, the spot is already discounted than the futures price. Price is really trading at a higher level. Next year, again, I'm expecting the market to rally further, because the way the buyers are showing their interest, especially on the physical side, has gone up really drastically. I'm from Dubai, and in the Middle East, bullion is one of the key resource of trading. As of now, the consumption has gone up really drastically, and as you said, the central bank buying on the gold is phenomenal. To purify gold, you need silver. So again, the silver is a byproduct for the gold, so it's in tangent. For a few years, silver was trading very lackluster, but now it has picked up very sharply in the last quarter of this year, and you have seen the prices at almost about 200,000 rupees in the Indian market. For 2026, I'm very bullish on the gold side. The reason is, again, the interest rate cut. I'm expecting the rate to be very sharpened, and you can see the price to around 2.5% US Treasury, which will give a trigger to the domestic, to the international market also. So gold, you can expect around 4,500 to 5,000 level, which will be the next year target, approximately with 400 to 500 rupees dollar rally in the international. With domestic market and with the rupee depreciating, you can expect the price to go to 150,000 rupees in the domestic MCX price. Whereas silver, it's already it's a lifetime high. Too much volatility can be seen, but stay invested will be my call, and I'm expecting the price to breach around 75 to $80 in coming quarter. In a domestic market with rupee depreciating, you can see the silver price crossing 250,000 rupees in a coming months. So buying side will be the call for me, and I'm still hoping this price will continue. Whereas we can also think about copper also, which is also trading at lifetime high, again supporting the bullion price.